Morning, John, and welcome back to Real Vision.
Thank you.
I wanted to start off with everyone's favourite topic.
And we know that is Tesla.
Absolutely.
It's like the most controversial stock in the world, and we have a tiny position short. And there's a big picture and a small picture, but the big picture is simply, this is the best example at the moment of turds mixed with raisins on the stock market. It's not my line, it's an old Charlie Munger line, but if you mix turds with raisins, they're still turds.
Right.
And Elon is, the good things you can say about Elon are at least partly true. The car is wonderful.
Incredible.
Nobody who's driven it doesn't get it. It's like, and moreover, electric cars are in lots of ways going to be superior to internal combustion engines in ways that you haven't thought through clearly. In the end game, an electric car should have the maintenance profile of an egg beater, an electric egg beater. In other words, it just won't need much maintenance. And I remember, my old Toyota Corolla 73 model used to have the oil changed every 5,000 kilometres. And my current car, it's every 20,000 kilometres. And the maintenance man used to be a serious mechanic, and now he just plugs a computer in and tells him what part he needs to bolt off and bolt on again. And it doesn't need maintenance anyway, it's just flawless. But we're going to get that step of improvement again. So that's the good bit. The bad bit is that Tesla's manufacturing quality is kind of awful, right? And you hear case after case after case of it. And that reflects in both warranty costs, it reflects in a few unhappy customers, and it also reflects in just his manufacturing costs being way, way, way too high. And there's a sort of big picture question here, which is, can he get his manufacturing costs and manufacturing quality to match Toyota or Volkswagen before Toyota and Volkswagen manage to match his technology in cars? And so far, I hate to say it, both Toyota and Tesla have surprised me to the downside. It's sort of annoying that Toyota or Volkswagen haven't achieved it yet. The new Jaguar I-Pace is in every sense as good as a Tesla, and the manufacturing quality is probably a fair bit better.
Twice the price at least, though.
Yes, but Volkswagen and Toyota, when they do it, will not be twice the price. The manufacturing quality will be astonishing when they get there. And then there's the series of it doesn't add up. And you could look at this 100 different ways and it's not going to add up. The idea that solar roof tiles were going to be as cheap as asphalt. It's sort of bizarre. The weird manufacturing ups and downs, the rush to deliver on final day. And then there's the wacky conspiracy theories like, where are all the VIN numbers? And the conspiracy theory about the VIN numbers, and it's completely untestable, is that the VIN numbers don't match because Tesla is doing a Heelig-Myers. And I've heard this conspiracy theory from the Twitterati 50 times. So I'm going to spell it out and tell you there ain't no evidence, right? No evidence that's convincing. Heelig-Myers was the first AAA securitization to default. It defaulted in the early 90s. And it's hard to work out what went wrong, but I'm going to give you the bare thesis. Heelig-Myers was a junk furniture shop selling subprime furniture on installments. And the AAA strip was 55% over collateralized. So in order to lose money on the AAA strip, 55% of the loans plus the spread needed to default. And as it turned out, about 65 or 70% of the loans defaulted, and you wound up with the AAA strip being impaired. And after the event, it was discovered that only 25% of the loans corresponded to real addresses. Now, it's actually hard to work out what happened because the documents are terrible. And I went through bankruptcy court and litigation, and no one ever went to prison. But the absolute hyper-bear case was that they were selling furniture to fictional people. And then they would fill out a fictional loan and they'd put the furniture back on the store and they'd sell it to another fictional person and they'd keep repeating. And then when And they put these fictional loans into a securitization, sell the securitization to the market. Some of the cash that they got was used to pay on the interest on the past fictional loans, and some went into their South American bank accounts. And at the end of the day, they left, and there's a giant shortfall, and all the loans are to fictional people, so they're by definition uncollectible. Now, the wackiest conspiracy theory I've heard is
on
that
the VINs
is that the VIN numbers don't work because of that. So at one end you have these, Elon being a complete innovator.
But the cars have to end up somewhere, physically.
Who knows? In the Healy-Meyer case, no furniture ever moved. You just had furniture that didn't match reality.
Well, I saw one of these tweets where the guy had tracked the car. Once he gave it back to them and they'd bought it back at the wrong price sort of thing, he tracked the car on his app as to where it was in the battery level, what the level of the battery was, and it just parked. They hadn't tried to do anything with it. Battery had died. It had been there for 6 months without being tried to be resold.
The question is, well, has it been resold to a securitization vehicle that we can't see? Is there some bad asset-backed paper out there? Now, I only point this out because I actually think Elon's an amazing guy, right? The car really is amazing. And there are bits that don't make sense to me, like solar roof tiles. There are bits in the short seller conspiracy that are off the planet wacky. The idea that Elon is pulling a giant Healy-Meyers is a pretty large stretch, right? And there are bits out there, this guy really has changed the world, right? I mean, don't kid yourself, launching a rocket is hard, right? And there are a lot of hedge fund managers who are nowhere near that competent. I'm fascinated because it's really good stuff mixed with really bad stuff. And really good stuff mixed with really bad stuff is fun to watch. We are short. We're short about that much. If the stock goes to 400, I won't be very unhappy. I still wish I'd never heard of the company. Right, I've been short it for a few years and I paid a few years of borrow cost. I've had a small number of options expire worthless. If the stock goes to zero, I'll have a drink at Elon's expense and I'll actually be sad for the world.
But this is a philosophical thing between your shorts and your longs. Are you doing it on a fraud basis or a value basis? This case, in general, it's fraud. But
generally,
this one,
we short frauds.
Yeah. This isn't.
Elon has about 300 red flags. This is a company full of red flags. You show me 15 red flags of certain types and I'm short it. And every now and again I get stuffed by that.
Not just accounting things, but...
Not just accounting things. I'll give you an example. There was a company called Amarin last year, which was a biotech testing high purity fish oil for cardiovascular disease. It had associated with it a single person who I'm not going to name, who wasn't a director, but had done business with the company. And to my knowledge, that single person had never been associated with a company that didn't go to zero.
Right.
And so we were shorted. We weren't shorted because we had any view on the science. We weren't shorted because we know a lot about cardiovascular disease. We don't. We were shorted because it had a red flag. And the red flag is fairly good. And over the history of Bronte, we've run 1,000 shorts, and we've managed to run shorts through the bull market profitably. And almost all of them are chosen just because there's a red flag, and the red flag indicates that there might be fraud.
One.
Well, in this case, it was one red flag, but it was a really good one. And it was a really good one in the sense that there were 15 previous examples that this person had been associated with that had gone to zero. And if you're involved in fraud A, fraud B, fraud C, fraud D, fraud E, and you're now involved in stock F,
And never been to prison.
and you've never been to prison, I'm going to guess that stock F is a fraud.
Reasonable.
And in this case, I was wrong.
Ah.
And I wasn't wrong a little bit, I was wrong spectacularly. So it turns out that in their double-blind study, high purity fish oil looks better than statins at reducing heart attack. right? To the point that I think pretty well every adult over 50 is going to be on high purity fish oil at some stage in their lives. And they have a registered version that's going to get FDA approval as a drug. And the market is potentially huge because it's taken as a prophylactic effect. The stock was trading at about $3 the day before the results came out. And it's trading at 19 now. We covered it at 14 on the way up, just reading the results and thinking, oh, Jesus. Now, there's a fund run by a friend of mine who didn't tell me he was long to the eyeballs. But he was long to the eyeballs, and he was long on the science. Right? Now, as I said, we've run 1,000 shorts over the history of Bronte. We currently have 200 on the books. We've managed to run 1,000 shorts and not lose money. In fact, we've made a double-digit percentage in aggregate over 10 years of the bull market. Now, I don't get out of bed for 2% per year, but it does allow us to be 120 or 130% long and have a beta of about 0.4. Right? There's a lot of alpha in the short book, but it's chosen on red flags. And some red flags, they're so good that just one red flag will be enough. We thought that with Amarin. Sometimes you need 5 red flags. Tesla has like 25. Right? There's no way that I'm not going to be short Tesla. But I'm short this much, just like I was with Amarin. And if I'm wrong, which I doubt in this case, but if I'm wrong, it's not going to worry me. Now, the other thing about Tesla is it doesn't look like the penalty for being wrong on the common is very large. Tesla has a market cap north of 50 billion most of the time. The market cap looks roughly like a completely unimpaired GM. It's a half a Toyota, right? And even if they get there, they're going to be copied. There's a large amount of capital needed to ramp up their production, right? It doesn't just, even if the current production were entirely saleable, which may not be, it's not big enough to justify the current market cap. In order to get there, they need sort of $15 or $20 billion of capital for expansion. Plus, of course, the shortfalls in the current book, which are not in, but I don't know how large they are. They're probably 3 to 15. If they're 3, Elon will raise it, and if they're 15, we'll be pushing up daisies at some point or other.
But they can't cover, you think, because of the margin or the margin loans?
Well, we don't know. Look, the business was profitable in the fourth quarter, probably and legitimately. And I do say probably and legitimately because I don't trust the accounts. There is absolutely no way it's profitable in the first quarter with the deliveries that they've done. Absolutely no way. Elon's admitted that it's going to draw a lot of cash. It's drawn down cash almost every quarter of its existence. The first quarter is evidence that the turnaround is not today or tomorrow. All right. Between now and the turnaround, if the turnaround ever happens, it's going to need a lot of cash. If that lot of cash is $5 billion, the bid in the stock is sufficient to pay for it. If that cash is $15 billion, then he probably needs to raise so much stock that the stock price will go down low enough to trigger his own margin loans. And that's a sort of catastrophe version for the longs. I don't want to express really strong opinions on this because I actually like the guy, right? I mean, I think, the world could do with a few more Elon Musks. Elon Musk could do with a bit of adult supervision.
Thoughts on the SEC? A bit toothless?
It's hard. Look at, Elon Musk clearly and flagrantly breached his court orders.
He's doing it now.
Yes, clearly and flagrantly breached his court orders. It wasn't even close. The penalty for a normal person for doing that is actually to be locked up. If you do that, Tesla collapses instantly. There is no judge and there is no SEC that wants to be responsible with their paw prints over the collapse, right? The SEC will investigate after the event. They're archaeologists, not investigators.
Well, I guess they're coming to the end of the 2-week period now, aren't they? Or they have to try and sort it out between them.
Yeah, they're going to sort it. There'll be some kind of rap over the knuckles again. If you think that a judge is going to do something that causes the imminent collapse of Tesla, you haven't watched the way that judges behave. Now, if Tesla were to collapse, he might wind up in prison as well for just breaching court orders, right? Contempt of court is imprisonable in most parts of the world, right? But as long as Tesla's alive and dependent on him, no judge is going to call it. And I don't know anything about this judge. I suspect he's like every other judge, competent and methodical and cautious, right? And cautious is the reason nothing's ever going to happen there. I can't understand why you would own it, but can't understand why you would own it is a common phenomenon in this market. Things are expensive.
Well, I think T. Rowe Price are beginning to agree with you. It seems like it's been taken up by retail from...
Do T. Rowe Price own a lot?
They really don't. Just announced, they just slashed it. They've cut their holding massively as of today.
I'm sorry, I don't follow other people's 13Fs.
But I think Robinhood has taken it, unfortunately.
Yeah, that Robinhood data, we're short sellers. And the classic thing that we short is a promoted fraud. We short whatever the hot stuff that can be sold to retailers. And the Robinhood data is somewhat useful when you see vast accumulations of crap in Robinhood accounts. It's probably somewhere near the end of the line.
Right.
And Robinhood have an open API that releases vast amounts of the data about their holdings. It's bizarre.
Yeah.
I mean, to give Interactive Brokers a plug, there's no question that paying a little bit of fees at Interactive Brokers produces better trading results than Robinhood. The Robinhood people sign a contract that allow them to buy several percentage points higher than the current market. I mean, the Robinhood thing is, let's give our data to hedge funds who know we're retail, and hence they can guarantee. I mean, the usual problem with a market maker is you're trying to cross a spread, ding, 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 ding. And the problem is that somebody wants to buy $1,000 worth of stock and you'll automatically sell them. And then they want to buy 5,000 more and, you know, it's within your lumber, you want to sell them. And then you want to buy 20,000 more and you might sell them. And now you're 30,000 short the stock. And then you discover that they want to buy 10 million more. And the market maker loses money on those transactions, but they make money on the small ones. So a person buys 5,000, they sit there, and they sell somebody else sells 5,000. As long as they're crossing spreads on small amounts, they will. The Robinhood is all small amounts. So the guys that are doing market making know that they're never going to get hit by that $20 million order, and they're never going to be on the wrong side of it. It's just an invitation. Hey, you know, I'm a small investor, rate me. It's like, I've never seen the idea that this is actually something that retail investors do astonishes me.
You use Interactive for execution? Or, no, you're an investor, I suppose.
I used to, and I'm an investor, and I miss them. We had...
PA?
No, I missed them for our fund. We actually had 100 million sitting in Interactive as a prime at one stage. And we were shorting stuff that was sold to retail, and so they had a really, really good borrow book. If you wanted to borrow $200,000 worth of some particularly crappy AIM stock, Interactive Brokers usually had it.
At GC?
Sometimes at GC, sometimes not. I'm going to give you pluses and minuses. It turns out that their execution is extremely cheap, and we've measured it extremely good. But their borrows outside the US are somewhat expensive, and inside the US, we did some price comparisons on borrows with Fidelity, of all people.
As a broker?
As broker. Fidelity has a prime brokerage service which has a really, really good borrow book in the US. And Fidelity's prime brokerage was cheaper on a lot of the borrows than Interactive, by about 0.5 percentage point. Which, you know, if you're shorting $200 or $300 million worth of stock starts adding up.
They didn't have Harvey Norman Interactive.
Yeah, they're not very good in Australia. And the reason is they don't have a lot of retail clients in Australia. Right? And if they don't have retail clients in Australia, they don't have retail borrow in Australia.
What I liked about them is when they alert you to, if you have a negative yielding currency, they say, you know you're going to have to pay us to hold that, which is very generous of them. Should we move on to longs?
No, but it's also fair, right? IB has a simple rule about, here is LIBOR. If you have deposits with us, we pay you 25 bips less than LIBOR. If you have assets, it's 25 bips more. Doesn't seem to matter which currency.
But the warning was good of them.
Yeah,
I should have known
it's
better.
also fair, right? I mean, the idea of negative yielding, the people who want to short bonds, and they have these negative rate bonds they want to short, but the problem is that they short the bonds and then they get a whole lot of cash and they've got to deposit the cash, and that yields even a higher negative rate than the bonds, so that they pay to short a negative yield bond.
Ouch. So longs and the world of longs.
This is hard. This is hard. We buy really high quality companies, and we're not interested in buying second tier companies because they're cheap. And the problem we have is that the really high quality companies are kind of expensive and they didn't go down last year. And there's a simple explanation for our returns in the first quarter, which is everything that went down hard last year bounced hard in the first quarter, and everything that didn't go down hard last year didn't bounce. And it's actually the worst stock we had in the fourth quarter was our best stock in the first quarter. But we have long after long after long after long that just barely went down. So, if you look at our fourth quarter, we were up, and we were running, in December, we were 130 long and 70 short, and we wound up 3% in US dollars. And our longs only produced -4 in December.
There should be some convexity in your shorts, I guess, right? Does that make sense?
There's all sorts of mathematical problems in our shorts. Right, our shorts, if you're running 200 shorts at any time, your management is a set of mathematical problems. It's not a set of, do I understand this business? I've just hired a mathematician. I actually don't know what he's going to produce for me. But then the idea, I guess, is to hire people who are smarter than you, and John Graham clearly is smarter than me on this stuff. So that should work. But yes, there are convexity problems. There are all sorts of other problems.
So how concentrated is the long book?
Our ideal long book is sort of 15 longs of 7 to 8% each, adding up to sort of 120-ish.
So 15 by 200.
Right. But if you look at our top 10 longs, that adds up to about 75%, right, exposure. We have a lot of little longs, and the classic little long is an extremely superior business that we met or worked out was superior, thought was a little expensive, bought 50 bips as a routing position, and come back 3 years later and the 50 bips is up threefold, and we just wish we bought more. There's a lot of those in the portfolio. And I'll give you an example. This is a long that's not in the portfolio. It's possibly the best company I know anywhere in the world. And I expressed it earlier and you had never heard of it. It's called Christian HANSEN, or just CHR HANSEN. And they make bacteria. Now, it's a really good thing if your business does a small but critical part of some big process, because then you can charge money based on that big process. And you want it to have a high switching cost. So if they change to a different supplier, it's going to stuff them up in some way. Then you've got this, really good pricing power, and they can't get away from you. Christian HANSEN's core business is it makes bacteria for yogurt. And in the old days, the way you used to make yogurt was you'd have a vat of milk the size of this room, and you'd have an old tub of yogurt, and you'd hit the old tub of yogurt in, and the bacteria in the old tub would spread through the new tub, and hopefully the yogurt tasted the same. And you'd get drift. You'd get the odd phage. A phage is a virus that eats bacteria. They're actually the most common pieces of animal on the planet. You would get stray bacteria so that the flavour would change. And every now and again you'd get a bad batch. And a bad batch was expensive because you'd throw out a pile of milk, the size of this room, say 50 or 100 tonnes of milk. These days the way you do it is you get some freeze-dried bacteria. And the freeze-dried bacteria comes from a factory, and every tub of freeze-dried bacteria is exactly the same as the last tub. And you just inject the freeze-dried bacteria into this. And then your yogurt tastes the same every time. And you never get a bad batch. Now, the branding and the flavour are interrelated. If you change brand of bacteria, you're going to change flavour. And then, people who are used to your brand will think maybe this is off. And then they won't buy it again. So the switching cost is very high. Then what they've done is they've selectively bred the bacteria for years and years and years and years. And they've selectively bred it so that the yogurt tastes creamier or the yogurt tastes sweeter. And you now see a plethora of low-fat yogurts on your shelf in the supermarket, and they don't taste like crap. And the reason they don't taste like crap is that Christian HANSEN has bred bacteria to make the yogurt taste creamier than it really is. Now, this is a product that you can really charge for. It's a small part of a very big process. It's got a very high switching cost. It just mints money. They also do bacteria for cheese. And every cheese you've ever seen has basically the same ingredients, milk parts and bacteria. And all the flavour differences are bacteria, right? Some French runny cheese and English Stilton have basically the same ingredients plus a different bacteria. And so there's a wide range of bacteria that they can use for flavours. And not only do they do 70% of the world's yogurt, they're probably approaching half the world's cheese and all the industrial cheese of the world. It's an astonishing business. And when I first found it, it was 6 times sales, right? Revenue was 6 times sales, and it was still growing, but it was sort of over half the world's yogurt, so I didn't think it was going to double. It's now 10 times sales. No, correction, it's 11.5 times sales, right? And sales have gone up a fair bit. Now, there's an old Scott McNally quote after the last bull market, or the tech bull market, and he's quibbling with his audience who are happily buying Sun at $64, which was just over 10 times revenue. And his simple question is, what were you thinking? In order to get a 10% return, I have to, give you 100% of revenue as dividend. And I don't have to pay, and I can't pay any tax, which is rather difficult. And you, dear holders, you can't pay any tax on your dividends, which is kind of illegal. And I've got to somehow or other pay my 38,000 employees. And I've got to do enough R&D to keep my position. What were you thinking? Right? You didn't need any footnotes. It was just done. And we're seeing these really high quality companies. And, Christian HANSEN may be the best company I've ever seen in my life. But they're trading at multiples that look like Sun at the height of the bubble. And you'll come back in 5 years and the question is, what were you thinking? And some of them will work. When Google IPO'd, it was 12 times sales. And sales went up, and then they went up, and then they went up some more. And I used to think that Google was getting ridiculous when the revenue was, and I still own it. So, I had to bite my tongue the whole way.
What were you thinking?
Right, but I used to think it was getting ridiculous when it was approaching the revenue of US network TV. And US network TV supports a lot of people. It supports cameramen, it supports all sorts of Hollywood types who have egos and fast cars and like their Teslas and whatever it is. But lots of egos and lots of people. And all of that is supported out of the revenue line of US network TV. And Google didn't look like it had cost structures that looked like US network TV. They looked a lot better than US network TV. And it was approaching the revenue of US network TV, and I thought, it's probably nearly done. The revenue's doubled and doubled again since then. And I've underestimated how far revenue can go the whole way. It's now trading at 5 and a bit times revenue. And given its cost structures look relatively light, it doesn't look awful, right? And
how do you compare this to the LYFTs and the Ubers? Because those, that's IP, that's technologically advanced businesses, new things. This is catching a cab and getting food delivered.
Yeah.
Right?
Uber puzzles me. I can't work out. I haven't read
The S1.
The S1 that came out this week.
Total addressable market is the
you told me about this. I was asked to guess what the total addressable market was, and I said, well, land transport's like 6% of global GDP, so I thought it's 5% of global GDP, so I thought about 6 trillion. And the answer comes back, but you've forgotten food, and you've forgotten all these other things. Freight, and they think the total addressable market's 14 trillion. And, you know, global GDP is, 83 or 4 trillion at the moment, something in that range. Right?
88, yeah.
88, I'm sorry.
And they're thinking 12 trillion.
Yeah, right. The addressable market's from a different planet. But what Uber does is it organises a taxi for me, and it takes 20% of the revenue, and all it does is a software tracking app. The only real service is I have a piece of software that connects this person to another person. This should be the most astonishingly profitable business in the history of Christendom.
And yet,
it hasn't made a penny.
In fact, 10 billion in the last 3 years.
I understand.
Losses.
But it's one of those, you ask me, would I short it because it loses money? And the answer is no. Right? Because the underlying business structure just looks like it should be the most profitable business in the history of Christendom.
And not a fraud.
And not a fraud. And someday or other, it just doesn't have very many of my red flags attached to it. And someday or other, if it really can be that profitable, well, maybe a management team will want to make it that profitable. At the right price, I'd go long the thing. I don't think this is the right price.
Hasn't been set yet, I suppose.
Yes, but I don't think this is going to be the right price. I don't actually have a problem with it, right? I tend to prefer my businesses have management that demonstrates that they know how to make a profit.
With a bit of a track record.
Yeah, right. It de-risks it a little bit, right? But when Google came public, it didn't have profit. And the revenue went further than you could possibly imagine. And the management team still look a bit fragile. I mean, part of the issue with Google is we don't know how much money they spend on their bets. It just looks rather black box-ish. But it's pretty hard to fault them, right? You know, if I'm saying they look a little bit fragile, I'm kidding myself. You know, they've done a way better job than you would rationally have expected.
At least they don't, you know, hundreds of them don't leave every year, I suppose, like Tesla.
No. They're not obviously running out of cash. Right. Whereas, you know, and I guess Uber at one stage, you know, is probably going to have to become rational because you can run out of, it's like the problem with socialism. You eventually run out of other people's money to spend.
In this case, the Vision Fund, or the Saudis, I suppose.
Whatever it is, you know, it's a great welfare program.
So you see this as a bear market rally, the first quarter?
Yes, but I'm talking my book.
You've got longs and shorts.
Yeah, no, but we're sideways, and I would be much, much happier with we tend to go up very slightly when the market goes down. But the real thing is that when the market goes down, our shorts are going to deliver us a big whack of cash. And that big whack of cash is there to buy Christian HANSEN at 3 times revenue rather than 10 times revenue.
Right, but it's not the beta of the shorts. It's when they go under is when you really make the killing. Right? Which is not beta.
Although if I can find longs at will and shorts with some difficulty, then I'm going to, which is not the case at the moment, but if I could, I would run with that. Right? If we come to a world where the Christian HANSENs, the really fine companies, are trading at 3 times revenue and the crappy companies are all blowing up, then I will take the profits that we made from the shorts in cash and go buy large whacks of longs. And I probably won't replace the shorts because if I can find lots of longs at willingness, the market's going to go up.
So you got stopped out a couple of times last year?
If you have 200 shorts, you get stopped out on some.
Yeah.
Right? We tend not to get stopped out very much. And the reason we tend not to get stopped out is that our starting position is like 20 bips. And we're actually tolerant of a short tripling, right? And the ability to just be tolerant of a short tripling means that you don't get stopped out very much.
But you don't add?
We don't add.
Okay.
You can't add at that point, right? Now, if a stock triples and our red flag looks like it was a mistake, we will cover it so fast it's silly. Amarin is my classic example, right? But there's an Amarin most years in our fund. Some of them really annoy me. There was a tiny little one. If any of your readers have ever heard of it, I will be stunned, called Oramed Pharmaceuticals. And Oramed Pharmaceuticals were testing an oral version of insulin. And the oral version of insulin was going to be wrapped in some kind of gelatin. And the first tests were phase 2As, which were safety tests. And of course they passed because it was a protein wrapped in another protein. It's going to be safe. The basic problem is that oral insulin ain't going to work because your gut is going to digest the stuff. The reason why it's given intravenously is that it's got an atomic mass over 130,000. And if your atomic mass is over 130,000 for a protein, your gut has to break it down to get it inside. You might be able to breathe it in, and that's a very marginal thing. There's a long-standing drug promote called Mankind, which was about inhaled insulin. Right. But this one was completely bozo. And it turns out that the chief scientist was undisclosed, the mother-in-law of the CEO.
Is that the red flag?
There were 20 red flags.
Oh, okay, there you go.
And we put it on our usual 30-bip position, and then they hyped the successful phase 2A test, and the stock went up 6-fold.
Oh.
We didn't cover it all, but we covered some. We finally took it off, down about 70% from where we originally put it on. 3-4 years later, no, not a happy ending. Because there's no way that we can recover the stuff that we short sold at $6 and covered at 30. And when it was up 5-fold, we had to cover some, right? We were stopped out, but we were stopped, if you understand. Right. And we kept some position on, but if a stock goes from $10 to zero via $65, I'm losing money on it. And if you have 200 shorts and you're right about most of them, it turns out that most of the place you lose money is ones that go from $10 to zero via 60. It happens all the time, right? And if you short 3% positions, and a lot of people do, one of those is going to give you a very bad year.
So this, in terms of hiding in plain sight, are you publicising, or you can't really publicise your situation? No,
we don't publicise our shorts at all.
But I mean, in terms of the story, you're involved in the Twitter sphere on Tesla, for
example.
Look,
right? I'm involved in the Twitter sphere on Tesla because Tesla's the most fun you can have on Wall Street.
Okay, gotcha.
Basically, it's the most fun you can have sitting in a chair.
Steady.
Steady, okay. But, it's really good fun.
Yeah.
Right?
It's just so much volume in terms of people's views. It's so emotive, clearly.
Yeah, look, I mean, the whole idea that Tesla is something between it's going to save the world from greenhouse gases and completely change the way we live.
It might blow up the world with those batteries.
To Helig Myers.
Yeah, really.
With nothing in between.
That's right, it's pretty black and white.
Both of those views are way too extreme to be real, is my view.
Yeah.
Right.
Somewhere in between.
Somewhere in between.
And we'll find out more on April the 24th.
We find out more every day.
That's true.
It's like, if you wanted to follow Tesla...
And do nothing else.
You could do nothing else with your life but follow Tesla.
That's crazy.
One of my staff refers to Tesla as a short seller distributed denial of service attack. It's so spectacular and such a sort of car wreck that every short seller is just like focused on Tesla. And there's all this stuff out there that they're ignoring, right? And they're ignoring it because Tesla's so goddamn interesting.
And it's big.
It's big, but it's colourful, right? I mean, when Valiant finally blew and they made the Netflix documentary, it was so colourful in the end, it was hysterical. I mean, the idea that a company registered a couple of hundred fake pharmacies so that they could send prescriptions to insurers without the insurer knowing where the prescription came from.
Hiding in plain sight.
And all of those fake pharmacies were named after characters in Stephen King novels.
Right.
Right?
Good one.
I mean, that's bizarre. But Tesla's that bizarre every day.
Absolutely.
Right? It's like...
Well, we'll see.
We'll see. But I don't want to play the Tesla denial of service attack.
Right.
Right? Because there are other things to do with your life other than watch Tesla.
Absolutely. Speaking of which, I saw you offshore recently, Japan?
Yeah, I was in Japan. And 2 weeks of that was visiting companies and 1 week was with my wife.
Potential longs.
All potential longs, although we found a few shorts on the way too. Because we can't help ourselves.
And microcaps or?
Everything from microcaps to large caps. But, you know, we have a sort of mystery. The Japanese mystery is you keep finding these companies that should make potloads of money and don't. And you're wondering whether they don't make potloads of money because the management have their fingers in the till, or because they're incompetent, or because they've got lifetime employment obligations, or because they have obligations to their counterparties so the money goes out via suppliers. In some Japanese conglomerates, that's clearly the case, where you have a company that is part of the Toshiba group and all the profits disappear because they buy overpriced services from other Toshiba companies.
And cross-holding based or just relationship?
Relationship based. And most of it is so opaque that the chance of a Westerner like me understanding it is something approaching zero. I have an example we've been talking about, which is a company called Takasaka. And I doubt you've ever heard of it. And not having heard of it means you've missed nothing in the world. Flavours and fragrances are an astonishingly good business. This is the business of providing a small part, but a high value part to, say, a food or a cosmetic that gives it its flavour, its texture, its odour and its branding.
A bit like the probiotic story?
Yeah, the probiotics, same version. That's how we found these things. Right. The biggest flavours and fragrances company in the world is a French-Swiss company called Givaudan, which is also one of the finest companies I've ever seen. And I went to their investor day in Jakarta, of all places. It was a bad thing that everybody at a food company's investor day got food poisoning, which is
classic.
I blame the hotel. It was a 5-star hotel,
call.
but I blame the hotel. Right, but it was really bad, I promise you. But Givaudan's offices are a bit like a sort of Willy Wonka, Charlie and Chocolate Factory experience. They have, for instance, rooms that they set up with coffee beans in them, and you walk in and everyone has a slightly different smell. And then they'll show you these smelling tubes you put to the nose, and there's 500 different slight variants on a coffee smell. And then they will sell a coffee smell to a chain of cafes. And you walk into the cafe and it smells like this really authentic coffee shop, but in reality the smell is coming through the air-conditioned conditioner provided by Givaudan. And that smell becomes the branding of the shop. And they will never sell the same flavour or fragrance twice. So one of the rooms they showed us had a bunch of smelling tubes in. You put one to your nose and it was Dove soap. And you know it was Dove soap. You've smelt Dove soap all your life. They made the fragrance 70 years ago. They've never sold it to anybody else. And it's a beautiful locked-in business. Small parts of a big thing, lots of pricing power, very high switching cost. Now, there are 4 big flavours and fragrance houses in the world and lots of little ones. The 4 big ones are Givaudan, which is French-Swiss, International Flavours and Fragrances, which is a stock that you will know if you have read Phil Fisher's books. It's one of the stocks in Common Stocks and Uncommon Profits. A German one called Symrise, which is the number 4, and the possible number 2 in fragrances and number 3 in flavours, which is a privately held company in Germany called Firmenich. And these are fantastic businesses. High teens margins, have grown forever, very high switching costs. If you go back 30 years ago, there was a fifth one.
The Japanese one.
The Japanese one called Takasako.
What happened?
That's a good question. Takasako say that their stated margin objective is 5%. When I went to Jakarta, the Indonesian people at Givaudan used to talk about the big five, but the only market outside Japan where Takasako has made an impact is Indonesia. Right? They have not spread in any meaningful way to the West. They have some astonishing technology. The most important piece of technology is that they have a catalyst business inside the company. And catalysts are also a fantastic business. It's a small part of a big process, but it's the bit that determines everything, so you get lots of pricing power. And they invented a catalyst that could catalyze molecules forming either right-handed or left-handed. Right, so that molecules can be symmetrically one way or the other, but they have different characteristics if they're one way versus the other. But it was always hard to make left-handed ones versus right-handed ones. And they had a catalyst that did that. And believe it or not, it's one of the few companies I know where their own research staff won a Nobel Prize, right, for doing that. This should be astonishingly profitable, and it's not. And they don't take meetings. We've tried and tried and tried to get a meeting with them. They have some English language material, but primarily because they want to sell stuff. They have a quarter the margin they should. And this is a bad thing because if you don't make enough money, you don't do R&D. Right? If you look at Givaudan, which is the best company in this space, Givaudan has 10,000 staff and only 3,000 are in manufacturing and back end. The other 7,000 are in pure R&D and development for customers. Right? So almost all of the staff are in the front end of developing new business. And if you have a fat margin, you can spend more money developing new business. Takasako has gone from being a genuine number 5 30 years ago to an also-ran.
You're not long.
No, I'm not long. And yet it has astonishingly good technology, and it has genuine leadership in some parts of flavours. It's the synthesis thing that the main product from that is menthol, which you can get from peppermint by refining, or you can get via a synthetic route. And they originally had a monopoly on the synthetic route, and then Symrise, the German company I mentioned earlier, also developed the synthetic route, and eventually BASF, the big German industrial chemical conglomerate, the mega cap, developed the synthetic route. But when they had an absolute monopoly on synthetic peppermint or menthol, they should have ruled the world for a while, and they never did. And it's like, this is Japan writ large. You find these companies with these utterly beautiful positions that for some reason or other just don't waste it. And you're sort of pinching yourself and thinking, God, I wish I could give the CEO a big pile of options. If you gave the top 10 brass a big pile of options and said, go out and get as rich as you can, then wonders would happen.
But it's not America.
It's not America. And it's like America has too much incentives on management,
yep.
Right? And they do stupid things because they're incented by options.
And the buybacks. Therefore,
well, we talk about buybacks, and Japan has not enough. Yeah, America, the classic is you give the person too many options, they'll buy back stock, and of course they'll buy back stock when they're selling their own stock, because, what's a buyback for?
Yeah, with debt.
Right. And they'll lever themselves up.
Silly.
Right? And there is a golden variety of that, the absolute case point, which is General Electric. And General Electric is a pretty bloody good company. Its jet engines are amazing. The technology that they just sold to Danaher, which was technology for making membrane separation and for making various proteins and biologics, was also amazing. Their imaging equipment's still the best in the world, and yet the company is near insolvency. Right? And the only reason it's near insolvency is it bought back $100 billion worth of shares. It also spent $10 billion buying Alstom, which might be worth minus $10 billion, and a couple of other mistakes. But if GE had only bought back $70 billion worth of shares, nobody would be stressed about it at all. GE is the poster child for bad incentives producing bad results.
Or the tipping point of leverage.
Yeah, but the bad incentives were all the way down. For instance, you had staff who were awarded based on various stated profits. And so anything that could advance profits, right, and leave risks in tails, rewarded them. There's a JP Morgan analyst who's really negative about GE, but his simple observation is that over the last 15 years, the top 5 staff have had $1 billion in take-home pay.
Wow.
And, you know, I thought I was well paid as a hedge fund manager, but, you know, I just don't cut it.
Not trying hard enough.
I'm not trying hard enough, but, yeah, but this GE problem is writ all over the place. My favourite example of, you know, buying back too much stock is Mattel. And Mattel make, you know, Barbie, boys' toys and girls' toys equal Barbie, and boys' toys equal Matchbox and Hot Wheels. And actually, it's a pretty hard business, and they haven't run it really well. And the reason it's a hard business is goddamn obvious, which is computer games, right? I mean, once upon a time, you could sell a Matchbox car to a 9-year-old, right? If you showed a Matchbox car to a 7-year-old, I mean, 7-year-olds just want Mario Karts. Right? The only people that buy Matchbox cars are 3-year-olds and creepy 40-year-old men. And
not I.
And the company bought back literally billions of dollars worth of stock. The debt is trading as sort of good single B. Right? But the difference between good single B and bad triple C is not very much.
What's the ratio of the CEO to median employee? Do you know what I mean? In comp.
Yeah, I know what you mean.
Just,
and I don't know. I never actually looked.
It'll be silly.
But, I mean, Hasbro has done absolutely everything right for 15 years. And by doing everything right, your sales are about the same as 15 years ago. Right? A little bit higher. But Mattel has not done everything right. And some of the things they did wrong, I would never have understood. Like my favourite example, which I'm not a consumer person, so I don't get this at all. But when it was pointed out to me, I go, oh. So I'll tell you. American Girl dolls.
Yeah.
Right? These American Girl dolls were ridiculously expensive, but you took your 5-year-old to the salon and she'd have a haircut. And the doll would have a haircut that was identical.
Bless.
And you'd walk out in identical sets of clothes, and the dearest dad would be down a few $100s. It was an incredibly profitable business. It had $700 million of revenue. And then they decided to sell it in Toys R Us.
Not quite so
exclusive.
exclusive.
They completely destroyed the cachet.
Yeah.
The revenue went from 700 million to 200 million. Now, for the life of me, I don't understand how to sell to consumers. I just don't get it. But it's still pretty obvious ex post.
Yeah.
Right? They've sort of stuffed it up.
Hindsight, powerful thing.
Hindsight's a powerful thing, but you could stuff up American Girl, or you could buy a few $1 billion worth of shares. But doing both was sort of a scary mistake. Right? And it's like, can I take some of this Japanese conservatism and sprinkle it?
But there is corporate reform going on there, right? It is changing. Maybe not by activists, but...
I haven't been there enough to know that.
Yeah.
The people that know it tell me that it is, and they keep saying, think about it being slow. So, for instance, in the corporate reform with cross-shareholdings, you either have to sell them or justify them.
With a one-liner? Yeah.
You just have to justify them. And so...
It was cheap.
You see people selling them, and then when they sell them, they buy back an equivalent amount of stock. So they are first buybacks. So we're seeing buybacks across the board in Japan. And when you go ask them, why did you buy back the stock? And they said, because we had to. Not because it was optimal for the shareholders, not because it would make the management rich, which is the American reason for buying back stock, but just because there was some kind of corporate law reform. We were sort of aching for somebody that said, yeah, we bought back the stock because it was cheap, and here's the measure of cheap, and here are our measure of what opportunities we have to grow the business internally. And yeah, we'll grow the business internally if it's optimal to do so. I was just waiting for a Warren Buffett view of the world, but I wasn't getting it. And I thought the chance of my getting it became thinner and thinner. Now, there was some exceptions. I'm not going to name names, but we went to see some microcaps.
Right.
And where the microcap had a family shareholder and the family shareholder was rational, you had at least fairly good governance, because the governance was that the family shareholder kind of liked their lifestyle.
Yeah.
And in one case, you know, the father had taken up with his mistress in the south of France, and the son was running it. And in fact, it was quite clearly run for the benefit of shareholders, which included the father in the south of France.
Self-interest.
And self-interest is a pretty good motivator. I mean, I just sort of wanting to sprinkle a little more into Japan. Right? And
But you came away with some longs, or you...
I came away with some longs, but nothing that felt like it was unambiguous. Right? Just stuff that felt really cheap, and with some optionality around it.
Value traps, potentially?
If they're buying back stock at all, probably not. But the risk is that the same risk that you've had in Japan for a long time, which is you buy a really good company, you wake up in 10 years and it's a slightly less good company, and it has accumulated a large amount of cash and the stock has gone sideways. Then there were things in Japan that you just scared the willies out of me. Like, lifetime employment is a real thing. Established Japanese companies do not fire people, and they do not buy them out except at the most extreme level of reluctance. But they fire nobody ever. And we asked about, you know, and they said it would be a national scandal. And that was the end of the answer. If you have high technology plus lifetime employment, it's a scary combination. Because the nature of high-tech companies is that they have beautiful global monopolies that last for 3 years. And you have to be able to deploy the profits of this to try and develop the next one. And if you don't develop the next one, you basically sell yourself or you fade away, right? But lifetime employment means the employment ramps up. A big pile of cash, right? Because they did make some genuine profit. And for the next 15 years, all that cash goes out the door to pay their lifetime employment obligations. It's the most shocking misallocation of resources.
But there are Western practices coming in. I mean, there's a SoftBank. These are mega caps where changing slowly.
If the Western practice is we make up our accounts, then, you know.
Okay.
We did find some frauds.
Okay.
Right. But
through the database?
No, a database doesn't work very well in Japanese, because mostly it's about chasing names.
Yeah.
And we're not very good at chasing Asian names. We just haven't computerized it the same way.
Right.
I have an intern who's just sitting over there listening, and he knows a fair bit about, he can speak Mandarin. So we are thinking about using him in part to work out systematic ways of chasing Chinese names.
But so your bottom-up approach, you're not thinking of whether we should be, obviously not thinking about whether we should be in yen, and therefore...
No.
You go on the trip with the specific alpha in mind, the names.
Yeah, look, we went, look, there are lots and lots of cheap shares in Japan. We're not sure we own any of them, even if we buy the stock. A lot of the time it was very straightforward. When you said, you know, why did you buy back shares? It's because we have a 7% ROE target and we buy back sufficient shares in order to meet the ROE target. Yep, they're not lying to you, right? They really do have a 7%. And guess what? You're going to make 7% return if the business doesn't implode. And if the business does implode, you're going to get screwed, right? 7% return's okay, but given it comes with a lot of risk, I'm generally not that interested.
So what's the geographical breakdown currently?
Look, we find shorts more easily in the US, and we find longs more easily in Europe. So if you look at us, we are about 70% short, 50% of which is in the US. We're about 60 or 70% long in the US and about 50% long in Europe, with a few incidental things in Australia and in Japan and things like that. But
no currency hedging?
Very little. I'll go back to Christian HANSEN, which we don't own. It's in, of all things, Denmark, which still has its own currency.
Oh.
Quasi-pegged to the euro, but it still has its own currency. If the krone goes up, Christian HANSEN's profits go down.
Inherently hedged.
It's inherently hedged, right? If we owned which we wouldn't, a Danish retailer, right, then we're actually got a currency exposure. We've never mathematically optimized our currency, to work out what our true exposures are. I mean, what we might do is do some regressions of our portfolio against various currency movements and pick the currency hedge that minimizes the volatility of the portfolio on the basis that we have no ability to pick currency, but anything that reduces risk is probably a good idea, right? But we've never done that. Most of the stuff we have is inherently pretty hedged just by its own business. There was a quarter a while back, which was the best, where the euro went from $1.30 to about $1.10 in a quarter. And in the same quarter, the European stock markets had their best quarter in like 20 years. Right? And if you looked at it measured in US dollars, our euro positions were just a wash. Right? Stocks were great. Currency was awful.
Yeah.
They matched. Right? And
like sterling at the moment, I suppose.
Yeah.
But let's not go there.
Let's not go there. Brexit is just a dog's breakfast. Yeah. The joke about British politics is that it exists to make Australian politics look competent.
Sad but true.
They're both pathetic. We are a little worried about it though, because one of the hardest positions we own long is Rolls-Royce. Oh. We've owned it for a while and it just looks like a Brexit dog's breakfast. Now, GE and Rolls-Royce are a global duopoly in wide-bodied engines. And wide-bodied engines they're going to sell a lot of over the next 15 years. The most fuel-efficient plane in the world is an A350. We've checked that with pilots. Hasn't had any notable problems. It's not a 737 MAX. A global duopoly in a growing business selling a high-tech product with vast amounts of revenue should be as profitable as hell. And it's not. And it's not through a variety of mismanagement problems, some of which they're probably getting to grips with. But if Takasago is a Japanese company that is under-earning, Rolls-Royce is a Western company that is under-earning. And it's not under-earning by a little bit, it's under-earning by an astonishing amount. Right? For years and years and years, GE's jet engine business had a margin that was 25-ish, 25 to 30. And it was real, right? The cash was largely all taken buybacks and then some, but nonetheless, it was real. And Rolls-Royce is lowish single digit. That company could conceivably earn 5x what it's currently earning. Certainly 3x is easy. And it's never failed to disappoint me.
But you're still long.
I'm still long. It's just that it's one of these positions. I went on a factory tour there. And, the factory tour was just good fun. I mean, what boy does not want to go to a jet engine factory? Right? If there's privileges in this job, one of the privileges in this job is the ability to go to a jet engine factory every now and again. And we walked around and saw various bits. And the most impressive bit was the testing room at the end. And the testing room, you walked through, You walk into a sort of linoleum covered thing that looks a little like my kitchen with a few computers sitting around, and it doesn't look very impressive. It's the control room for the testing room. Then you go through a pair of lead doors and walk down a set of stairs through maybe 10 feet of concrete and lead into an underground hangar the size of a football stadium. Wow. With jet engines strung up on cables and tied to the wall, and big black marks where the engines had been firing into the walls. And now you're in the set that looks like a James Bond movie. It's astonishing. And there's an X-ray machine so powerful that it could take your chest X-ray at 8 miles.
Wow.
And they use it to film the inside of a jet engine when the jet engine is running. Now, it turns out that every testing room, the testing room is the single most capital intensive part of the whole jet engine manufacturing process. Every jet engine comes in and spends a week on the testing beds while they do everything to make sure it really works, right? And this is X-ray it from all sorts of angles and do, right, and fire it and burn lots of fuel and make lots of noise. And every engine that comes back after its 5-year maintenance haul also goes through another week of testing. So you can sort of work out how many planes there are in the world and how many planes on their order book and 5-year maintenance cycles and how many testing rooms they need. And it turned out that they needed many more. And these testing rooms were about 100 million quid each. And we sort of did the back of the envelope and worked out that they had about £500 million to spend on testing rooms. And they had done the back of the envelope by the time I was in the factory. But quite literally, they hadn't even done that back of the envelope calculation 3 months before we met them. Right? That is, they had pre-sold all these engines on the A350. There's a forward order book as long as your arm. And it's pretty obvious they're going to be profitable, I think, touch wood, right? But they hadn't even worked out how much capital they needed for the ramp-up. It was the weirdest case of engineers not thinking through finance.
So you're going to stick with it?
We're sticking with it. I said that 3 years ago and the stock is sideways.
Decent yield.
No, they actually halved the dividend along the way. And they had to halve the dividend because suddenly they realised, oh my God, we've got to spend $500 million on testing rooms, £500 million on testing rooms. So this has just been a hard situation. And, I was sort of cheered when Value Act, who are actually, pretty good at this sort of stuff, got involved and bought 10%. And Value Act has just trimmed their position the other day.
Uh-oh.
And I'm thinking, I'm getting a tiny little bit squeamish here. And, Value Act and I are actually fairly good friends, primarily because I was on the other side of Valiant with them. And they held this huge mega position in Valiant. And it's kind of mutual respect because I've looked at the things that they've done really well and they've done them really well. And they seem to respect me because when they made a mistake, I spotted it. So it's a nice situation. But Rolls-Royce also has the most complicated supply chains you could imagine. Right? There are millions of parts that come from all sorts of places. Each part has to be tracked, X-rayed, tested for integrity, right? Expensive and complicated process making jet engines. And you look at it and think, Brexit? This is diabolical.
Outside of customs union?
Outside of customs union. Oh. Now, we had some Brexit hedges on. I'm not going to tell you what they are because I want to put them back on later.
Okay.
Right. But the only stock we have that scares me for Brexit is Rolls-Royce. And it's sort of also a measure of the irrationality of the whole thing. There was a town in Wales where the only big employer was the Airbus consortium. And they had a factory with a few thousand people working for Airbus. And the town still voted majority for Brexit. What were they thinking? It's the same,
Not well explained.
Not well explained. Anyway, so Brexit just looks bizarre to me. But, then so does politics at the moment. There was a consensus in politics from Margaret Thatcher to about 5 years ago And the consensus was that free markets and liberalism was the way to get rich, good rule of law, free markets, free trade. And there was a left wing of that consensus and a right wing of the consensus. And the right wing of
way more extreme now.
And the right wing of that consensus said, yeah, and freedom and free markets and getting rich is an end in itself, right? And that's good. And the left wing of that consensus said, and yeah, getting rich meant that we could have a more robust tax system, we could afford a welfare state, we could afford environmental protections, etc. But they both agreed on the free market bit. They don't even agree on that anymore.
It's not a free market.
Right? They don't agree on that, right? Well, no, there's a perfectly respectable view that says you have a neutral tax system that takes 35% of whatever, right? But you have an otherwise completely even playing field. People, 75% of your profit is still a pretty good incentive for most people. Or 85, 70 or 65% of your profit is, doesn't kill incentive, just dampens it a little.
But it's the access to capital. Inequality is just driven higher by central bank action. So if you can't get access to capital.
I'm firmly on the left wing of that view, which is that by and large markets are the way to get rich for the whole of society, but you need to have a tax system and a welfare system and an education system so you don't leave large classes of people behind. And the cost of leaving large classes of people behind is becoming apparent at the moment. Right? And the cost is ultimately, this is a democracy and they vote. Right? And you either treat them fairly, right? You treat everybody fairly in some sense.
Or face the unrest.
And Brexit is the classic example. I mean, there was no rational reason to vote for Brexit other than it was opposed by the elites and I want to stick it to them.
It's the marketing, I think, inherent in the NHS.
Yeah, but
funding mumble.
The marketing was appalling.
It was lies.
Both sides, incidentally.
One side didn't try very hard.
No, because they thought they'd win.
Yeah, arrogance.
Yes, but that seems to be
common factor
these days. It's sort of annoying because the free market delivered a lot of goods, right? The post-Margaret Thatcher globalisation of the world worked in a very, very big way. It just worked somewhat unevenly. And then add in free money, a central bank and asset price inflation, and then it worked extremely unevenly. I don't want to pontificate about it. I just need to work out how not to lose clients' money when it unwinds.
Excellent.
Right? Because that's really the job.
Well,
my job is, of course, wealth inequality is fine. Most of my clients are rich and I want to keep them that way.
That's right. Okay. It looks like we've run out of time again. I know we got criticised last time for bringing it to a very abrupt close, but we've got more interviews to do today, and great to see you again, John.
Bye.
Thank you very much indeed.
Thank you.